Tesla has been a stock that has not disappointed its investors. It's seen incredible growth in such a short period of time, and its inclusion into the S&P 500 sent a lot of questionable analysts running with their tail between their legs. And that's something I think needs to be said right now. Tesla's price target has changed dramatically. Even just a month ago, we had price targets in the 200s, and a couple months ago, our lowest price targets were in the 80s, 50s, and the consensus was double digit. It's shocking and crazy. Tesla definitely went through a very rough time years ago, but to have these sort of price targets with their performance and their continued growth, I thought was insane. I've made a couple of videos like this before, such as, is $1,000 the new normal for Tesla? Tesla went through a 5-for-1 split, so to convert the prices, that would be $200. And I was very bullish on Tesla. I thought they would blow past $200, maybe spend some time chilling there, but I definitely saw continued growth in the company. And then they doubled in price. They hit $2,000, and I made a video on that. That's $400 after the split. And I was very confident that, yes, they would go past $400. Again, I was expecting maybe a bit of relaxation time, a bit of flat trading while things are reevaluated. But they were absolutely hitting their metrics and growing at a ridiculous rate, investing heavily in their infrastructure for factories and battery technology. I do intend to make a video going into detail with why I evaluate Tesla the way I do and why I'm so bullish on the company. But I haven't done an update on its dramatic price shifts recently. And it really is insane to see some of these analyst numbers and just how incredibly low they were. But obviously, inclusion into the S&P 500 has really changed a lot of perspectives. Tons and tons of people are arguing about this, and tons of firms have bought Tesla. We actually saw a giant jump on that day right at the close. And I should have made a video on this, but a lot of these big firms want to avoid what's known as tracking error, which means it's the divergence between price behavior of a position or portfolio and the price behavior of a benchmark. Almost all of these firms are benchmarked against the S&P 500. It's the largest ETF in the world, and it has had a very consistent rise, averaging 11.64% annualized returns over 10 years. The S&P 500 is a standard for investments, and that's why all of these big mutual funds and ETFs are benchmarked against it. Because of this, they really care about the close price. And if they are an S&P 500 tracking fund, then they're going to be placing a lot of these close orders, either limit on close or market on close orders. So all the action on that day was going to happen at the last 5 minutes and right at close. And I was able to take a big advantage of that because when I saw Tesla stock dipping right before close, I bought up as much as I could. We saw a huge spike, and I sold it for quick profit taking. And then, of course, I bought some more back once that was done. We saw a little dip in the morning as the market reacted, which I expected. But even beyond that, there's reasons we've seen a continued rise. Tesla has obviously been doing great on factory construction and expansion. Their battery technology and development has been continuing to grow. Their full self-driving energy, it's all developing. The company is just growing at a consistent rate and doing well. But there are a lot of reasons why tons and tons of big firms are buying a lot of Tesla. It all goes back to tracking error. If these big firms don't necessarily like Tesla, but Tesla continues to go up, then they get tons and tons of tracking error and they kind of murder themselves. If they don't know what to think about Tesla, or maybe they even slightly dislike it, they're going to end up buying Tesla anyway. And the reason for that is they want to hold the same proportion as the S&P 500. Because if they're uncertain on Tesla, it's just going to move with the S&P 500, and they won't get tracking error from it. That way, they can leverage the positions that they do feel comfortable about, that they do feel like they know and understand. So as weird as it might sound, any of the stocks in the S&P 500 that a mutual fund or hedge fund manager isn't comfortable with, they're probably going to buy just to avoid divergence, unless they're incredibly bearish on the stock. But it's obviously screwed over tons and tons of shorting companies. I mean, tons of huge companies have been saying absolutely stupid things. Like on December 9th, JP Morgan, with a incredibly low $90 price target, which they boosted from $90, is just absurd. But these big corporations were out there saying this. And that's not to imply that every big corporation hates Tesla and that they have no commercial support. Tesla has done a lot of capital raises, and there have been tons and tons of huge institutions that have been involved with them. I know Bank of America and Wells Fargo always like to buy up Tesla stock every single time they do a capital raise, and they've had no issue getting billions and billions of dollars. And with such a high market cap, they don't really dilute their shares that much by doing these capital raises, but they build up their war chest, as Elon likes to call it. So we've seen consistent growth from Tesla. Very spiky, but still continued growth among all of these huge mutual funds buying the stock and the company just developing naturally. I do plan to make a video about Tesla and their fundamentals and how they are in 2021, how I view the company in 2021, because they've changed a lot even in just the past few months. Their growth is insane. They've been hitting all their marks on deliveries. Their home energy sector has been doing shockingly well and has been aggressively expanded. And this is a company that sells every car they make. If you go on their website right now, their estimated delivery is 6 to 10 weeks. Even if we change the model, 6 to 10 weeks, 7 to 10 weeks for the performance. And this is for the arguably less popular Model 3. Tesla's been aggressive on Model Y production, mainly because the US is infamous for being really SUV and truck focused. They like these larger vehicles, not really sedans as much. But even then, we still have 2 to 6 week wait times for a more expensive car. Whenever you boost the price, way less people can actually purchase a vehicle. For a more expensive vehicle, we're still seeing 2 to 6 weeks of wait time. For the long range, 2 to 6, and then performance, it does jump up to 6 to 10 weeks, which is insane because when you look at the purchase price, that's a $60,000 car, not considering full self-driving. $60,000 for a performance SUV. It's such a small market, but every single one they make, they sell. It's really shocking how well they're doing and how much demand there is for even these really expensive premium products. So I just want to say hats off to Tesla. Like always, I'm bullish on the company. I'm very happy with where they've been going, and they've just been growing like crazy, not just price target wise, but just as a company in general. You know, if you're a Tesla investor, pop a bottle of champagne and enjoy yourself because it's been a really nice year for you. If you want to jump into the stock market and get started trading, Webull is a fantastic brokerage option. If you sign up using the referral link in the description below, you'll receive 4 free stocks. 2 of them will be valued between $2.50 to $250, and the other 2 as part of the deposit bonus will be valued between $800 and $1,600. That's $2,100 to $3,700 just for signing up. Again, the link is in the description below, and happy trading.